But HDFC Life, if we can go across to Vibha Padalkar, the MD and CEO at HDFC Life Insurance. Okay. Vibha, hi, good morning. Good to have you on the show. And we've seen quite a strong premium growth, increase in market share, increase in embedded value expenses ratio. That, of course, is down. What's contributed to the overall improvement in the market share and the embedded value, you think?
So we've always believed in a balanced distribution mix as well as tech-led solutioning. And both of these have come in extremely handy with the backdrop of a pandemic. And when you look back to Q1, when really everything was shut except a few branches here and there, it is that solutioning that enabled us to reach out to our prospective customers. Also, bank branches were open, and so our people were also there and were able to connect with customers virtually. And hence, you'll see that, especially in Q1, as well as Q2, you'll see bancassurance and online and through digital modes doing very well. A noticeable shift is that towards Q3, our agency channel also started picking up speed and learning to not have face-to-face communication, but at the same time being able to sell. So all of that coupled with the fact that we had the products that people wanted to buy, especially those that were somewhat of guaranteed products that were perceived to be less of a risk. And people started allocating higher ticket sizes also to those products. So it's a combination of all of them that came together that helped us increase our market share by over 200 basis points in the first 9 months.
Right. Vibha, so, while a lot of parameters have done well, what's led to the decline in the 9-month VNB margins to about 25.6% from the earlier 26.6%? Also, what's led to this just 0.1% growth in value of the new businesses?
Yeah, certainly. In fact, the aberration was there last year. And last year, if you see the trajectory, our margins were fairly high in Q1 because we had launched Sanchay Plus, our blockbuster product, and that did exceptionally well. But over the quarters, we brought it down from Sanchay Plus being almost 60% of our business down to about 30% of our business and a little bit lower. And so Q1, Q2, Q3 trended downwards. This year, it is actually trending upwards. So if you were to look at our own margins, you will find that kind of upward trajectory. And if you look at for the standalone Q3, that's exactly what I'm saying, wherein standalone Q3 was 26.4% margin, and last year Q3 was 24.7%. So it's almost like an inflection point that is happening. And because of that inflection point, we are cautiously optimistic that we should exceed full year margins that we put out last year of 25.9%. To your point about the value of new business growth, exactly for this reason of that inflection point is what you see in the VNB of being flat, almost identical, this 9 months versus last 9 months. But if you look at on a standalone VNB for the quarter, you'll see a 27% growth. So 450 crores went up to 570 crores. And so you'll continue to see this kind of acceleration in VNB as well as margins in Q4.
Yes, but Padalkar, share with us, for the benefit of our viewers, what has really led to this 20% growth year on year in the Indian embedded value at 25,000 plus crores, and what is the outlook ahead here?
So it is, again, a combination of a couple of things. There is a new business margin that we talked about. So the addition of over 1,000 crores does help in terms of accretion to embedded value. So we ended at just about 25,000 crores of embedded value. So that 1,000 crores was there. There's also an unwind of the back book unwind. And also this time we were helped by markets. So about 1,500 odd crores was because of mark-to-market impact on the embedded value, thereby getting us to 25,000 crores and about, like you said, a 20% growth. embedded value operating profit, which is really controllable by the management team, grew from 18.1% last year to 18.3% this year. So that again is something that we are fairly satisfied with against a fairly difficult macro environment.
Now, the protection business growth has also been healthy. How do you see the share here of the protection business and the overall product mix over the next year?
So we saw a 17% growth in protection, and the other end of spectrum of protection is annuity, which is the longevity protection. There we saw a 42% growth. So fairly happy with the levels of growth that we see, and also the number of policies trended upwards. To your point, how do we see this panning out? Just given the fairly low levels of protection as well as low levels of coverage for senior citizens, both ends of the spectrum, we expect to see fairly robust growth. A 20+% growth year on year should be very doable.
Okay, we have seen an improvement in persistency ratio. We've seen a lower expense ratio as well. Are these trends sustainable?
So I would continue to see an upward trend in our persistency. Certainly 13-month persistency, you're seeing that noticeable change. The 61st month persistency is a little bit more difficult, a little bit stickier, because it's something that we sold almost 5 years ago. So undoing that and finding those customers who did not pay their premiums and then explaining to them it continues to be a challenge. We try and do it, but continues to be a challenge. That's why you'll see this in two-prong, 13-month getting better, 61st month taking a little bit longer until the new cohort comes in and is replaced by a higher quality cohort. What would help is that in the unit-linked space, if there could be some barriers of exit, it would certainly help. Also, either doing away or significantly reducing the interest that people get when they lapse their policies on their discontinued policy fund would again help, because we need to tell people that it's not in their interest to lapse their policies, and very clearly give the message that these are long-term products. As a company, we do it, but also the construct of the product could help. But yes, we are very aligned that persistency has to trend up, because someone who is not persistent, the customer is going to lose money, is going to be aggrieved, and the company also doesn't make money. So it's really not a win-win, it's a lose-lose proposition. And so this focus will continue to be there on getting the persistency numbers up.
All right. Okay, COVID has changed two important factors. I mean, the way business is done as well as consumer perception towards insurance as a product as well. Now, with the vaccine rollout already taking place, when we're looking at over the next 1 or 2 years, what are some of the lasting trends you see, both business-wise and on customer behavior?
So one thing is that people will buy more health insurance. It isn't directly impacting us, but we do sell bundled products, so it will help us to do more of that. Second is that people will look, maybe with a little bit of lag, maybe with a little bit more homework, but they will come and search for pure protection products. That is a second aspect. Third aspect is savings-related protection is not going to go away. They have come back with a bang. So they will also be looking towards getting to the same goal if they can do this through savings, especially if they are above 45 and have already some health-related issues. So buying a term product might involve them going for medicals, which they perhaps want to defer. So that also will remain important. Retirement will continue to gather steam, especially with more and more central government employees, for example, or PSU employees, also now looking at buying annuities from private sector companies. NPS will continue to make a lot of sense in that space also as a good retirement avenue for people who are today maybe 40 and 45 and above. So all of these patterns are emerging depending on what age group and what dynamics one is in terms of salaried, non-salaried, and what one's risk appetite is. And on risk appetite, guaranteed product or even participating products will continue to do well against a backdrop of volatility.
Vibha, budget round the corner. What's the expectation for the insurance sector?
So this is an old ask. If there can be a separate carve-out, not under ATC, but separate carve-out for insurance, pension, and so on, that will be great because people do need that nudge and push, and more so for pension. For saving for a rainy day that might be some way away. And second is on annuity, because annuity is tax twice, especially if you're a salaried person and from your post-tax salaried savings, you buy an annuity. When you get an annuity, until say the next 20 years after retirement, that is taxed again, which is not really equitable. So if there can be a deduction for say the purchase price one has paid to buy an annuity, that will be a great equalizer, and hopefully it will spur people to buy annuities, look after themselves, and financially to be independent. Really, sar utha kijiye.
Vibha, great to have you on the show, and we'll chat again post the budget soon.